Hello and welcome to the market update for Tuesday, January the 17th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. Write that down so that, especially if you're new, so you know how to get a hold of me to get questions answered. Yeah, it's also going to be on the recording. So if you're reviewing the recording, you know how to, if you can't attend the live class, again, you've got a way to ask me questions. Just send them to that email address. Again, before I get started, like I said, recently I've been having some issues with the audio, having a little bit of a clicking noise, although I think we've narrowed it to really only the Thursday class that's having the problem. But if you're hearing a clicking noise on your end in the audio, please let me know. I can try to dial back in. I think on Thursday, that's what I did. I dialed back in and it got rid of it. So if you do hear that, let me know and I'll dial back in. But I'm going to go ahead and get started. I'm going to assume it's okay. I'm going to go ahead and get started. Really not much has really changed in the last couple of updates. We're still sitting at just this critical resistance area, and it's hard to do anything because until it makes a move out of this area, breaks out above it or starts to reverse back down from it, we're kind of in limbo, and it's as a trend trader, I want to wait for the market to establish the trend. I don't want to try to guess which direction I think the market should go or guess what it's going to do. I've got to be really focused on where it's headed. And this gets back to, some pretty strong opinions I've had over the last couple of months, being pretty bearish on the market. You still have to recognize what the market is actually doing. And if you're bearish on the market, but it's breaking out and going up, you've got two choices. You can dig in and try to find reasons why you think you're still right and probably lose a ton of money, or you just shift and go with wherever the market is headed and follow that direction. Because remember, as smaller traders, we can't move the market. We can't cause the market to go up or go down with our small buying or selling that we do. We're relying on those big institutional traders to move the market. They can move the market, and so what we've chosen to do, at least if you're following this software and following the basic philosophy of this company, is that you're just trying to get really good at recognizing what those big professional traders are doing, and then just following along. We're just going to kind of ride the coattails. And again, it doesn't matter whether they're right in what they're doing or wrong. They're the ones that are moving the market, and so it's going to go in the direction of collectively what they're doing. Now, that makes it sound like there's one big, huge trader that's causing every market move. No, there's lots of these big institutional traders, and sometimes they can disagree and have opposite views, and that can cause the market to kind of slosh back and forth a little bit. But it will then establish a general direction, and that's what we're trying to identify as what that general direction is. All right, so as far as the direction alerts are concerned, I'll show you on the charts here in a second what I'm talking about as far as this critical area. But we're not showing any sort of. We're starting to inch closer to some extreme indicators. The momentum's still right in the middle, moving closer to the buy area. It's moving in this direction over the last few trading days. The breadth is getting close to that extreme range, but again, it's not there yet. And really what we look for is not only getting into that extreme range, but to get to the far right side of that. What that indicates is an overbought condition. That means the market's getting a little bit stretched to the upside. We're not there yet as far as those two indicators. So what that tells us is that the market can continue to trend in the direction it's moving in, or it can, it has room to reverse trend as well. It's in a condition where it can trend, it can continue to trend. Now, it's been trending up recently since the beginning of the year. So what these are telling us is that if the market wants to continue to trend up, it can continue to trend up. It's not stretched, and that's all we're looking for at these indicators is seeing if it's stretched. Now, it is stretched on the sentiment indicator, and you can start to see what I keep talking about is it's getting really, really crazy as far as how complacent the market is getting. You look at, this is the extreme right here. This is when it gets to this area right here, and usually you see the market start selling off and seeing that sentiment come back in. Look how high above that we are. That is really, really, really stretched. And so we tend to, when it gets stretched like that, we tend to be a contrarian at that point and say, boy, that's you think that the opposite should happen when it gets that stretched. However, again, the other two indicators aren't stretched yet. So, and this has been crazy overbought for a while. So could this continue? Yeah, it's possible it can continue to, the complacency can continue to be high. But I tell you what, if we do break out of this condition here and you start to see these the breadth indicator get into the extreme range over in this area right here, and at that point, if you start to see breadth, because it's already kind of ahead of momentum, but if you see breadth get into that right side of that extreme box, and you see momentum enter the extreme box, look out, because that'll tell you that you've got a stretched market and a very complacent market, been complacent for a while, and that's a recipe for a pretty big pullback if that ends up taking place. Now, we're not there yet, so we'll keep an eye on that. As of right now, I don't see anything really stretched or overly stretched. Buy-sell ratios are getting a little bit wide. You've had a little bit of a good run here with the buys outpacing the sells. But you can see it's gotten a little bit more stretched than where it's at. So there's still some room to run there. That's part of the problem is if you wait for this breakout, and again, the breakout I'm talking about, I'll show you here in a second on the chart. Even if it does break out, it may not run very far before correcting again. So it puts us in a weird situation where the market could start to look more bullish, but we wouldn't want to be buying in at that point because it's also stretched. You'd want to wait for the next correction, at least to get aggressive. You could find maybe find some things out there. Although I didn't find any. I'm not going to have any stocks I'm going to talk about today because I didn't see anything I liked. I looked at quite a few areas, and a lot of the stocks in some of the sectors that are moving already are looking a little bit overbought or stretched. Some of the gold stocks, in fact, we'll look at the ones we're holding in the portfolio, probably due for a little bit of a pullback. Just nothing that looked like a good entry point. So I'm going to hold off and wait to see if there's better ones on Thursday. But so this is starting to get a little bit stretched. We'll keep an eye on that, especially as it relates to the other indicators. The sentiment indicator is not quite there at the overbought area, but it's approaching it, getting close. It's kind of past the midpoint. Here's kind of the midpoint into here, but it's not there yet. So what this basically tells me is that we could continue to trend in the direction we're moving in, or if it does find resistance in this area and starts to sell off, there's room for it to sell off. It can really have room to sell off before it gets oversold. So there's a lot of potential to the downside as well. And to be honest with you, man, I've been getting there's a lot of mixed signals I'm getting in my analysis. I can make a bullish argument in many cases, a bearish argument in some cases as well. And I don't like that. I don't like it when, I don't feel strongly that the market should be moving in either up or down. I don't care where it goes because I can make money either way with whichever direction it moves in. But if I start seeing mixed signals out there, then it doesn't give me a lot of confidence in any direction. And it's usually a sign that you want to back off a little bit, not take as much risk, be patient. And we've been being patient for a long time, but you have to be patient in bear markets in general. But the good news is that when, the conditions can change pretty quickly, and I could be, looking at a lot of mixed signals one week, and then the next week, a lot of strong directional signals. And things can change that quickly. And so it's not like you're in these areas of limbo for very long in most cases. I've had a few situations in my trading career where limbo type conditions have lasted for months, a couple months or so. That's really frustrating because it just feels like you want to do something, but there's just, you don't feel confident in either direction. All right, so let's take a look at the charts here. And hopefully I don't, because we're kind of still in the same area, I don't want to just kind of keep repeating stuff I've said in the last couple classes. I'll try to, I know I do have new people that jump in, so I have to kind of make sure I don't just assume that they've gotten caught up on previous updates. And for some reason, it's been, I don't know if it's the site or my internet. It's been a little bit slow today. All right, let's take a look at the SPY. And again, I want to start by backing out to that 2-year chart, because we have to watch. This is what we're keeping an eye on here, this downtrend line. Every time we've hit that downtrend line, the market has sold off. Hit it right here, sold off. Hit it right here, sold off. Hit it right here, sold off a little bit, came back. That was that CPI report that came out where it opened above the line, broke, it looked like it was breaking out, and came back. At the end of the day, it closed back below the line there. We had this sell-off right here. Now we started to have this little corrective move back in December, and usually when you see that, you're going to get another impulsive move down, but we didn't get that. It kind of inched its way higher, but it came back to that trend line again, and it's just been sitting there right on that trend line. Now, I thought we'd have either, I figured by now, because it's hit it last week, and I figured by now either we're going to break out above it or we're going to see a move down, and we've just kind of hovered in this area. And it's critical, because if we break out above it, and I'd like to see a clear break above it, not something that's still right at that line, because sometimes with the trend lines, you could look at what scale you're using for your chart, or there's different. Is your chart based on the percentage moves or the dollar moves? It can distort the chart a little bit as far as trend lines are concerned. You could make a bullish argument that the S&P 500 did close above the 200-day moving average. We don't look at moving averages here on TradersPro, but that is something that professional traders do look at. But I've seen stocks move above or below moving averages and then reverse right away. I've seen that a million times. That's not always the most solid reason for a trade. You'd like to have other things on top of that. So I'd like to either see a clear, now if we get a clear break, you get a clear break of that trend line, get somewhere up in this area up here, that would actually show a lot more bullish, a possible bullish reversal. It'd be the first time during the whole decline that you would have broken that downtrend line. It would have also, back here, you had a lower low right here. If you break out especially if you break out above here, that would give you a higher high on the trend, and you could look at this as a higher low. That's acting like an uptrend, a trend reversal. So you get these, whenever you get trend reversals, you get these little subtle clues. I wish we could say right at the bottom, okay, this is the bottom, and it's going to go up from here, but you never get that. That's why you can never perfectly pick a bottom unless you're lucky, because typically what happens is you see it start to act like an uptrend after it bottoms out, and it shows some clues early. You can take advantage of that by entering into some positions, and then as it continues to confirm that, you can add more, and there's stages to the process there. You're not going to go all in when it shows little clues that it could be reversing, but you would start to change your outlook. We've been bearish for over a year now. We would need to start to kind of change that mentality a little bit. And it's hard to do that too when there's a lot of reasons to be bearish. There's the earnings are probably not going to come in very well this quarter. Now, don't judge earnings season by the bank earnings. Bank earnings have been great for the most part, at least, because of the bond yields being higher, interest rates being higher. Banks have been able to take advantage of some of that stuff with particularly higher interest rates, and so they've got that. That's kind of free money for them, that income, and so a lot of them are going to show profits. Although some of the banks have been sold off a little bit off of their earnings reports. But the key is going to be when Apple and Google and Amazon and Meta start reporting, and that's when everyone's going to really be focused on that. I've made my argument of the Fed, what the Fed's goals are, and you don't want to be fighting the Fed, and it seems like the market is fighting the Fed a little bit. But the bottom line is the charts. Okay, what are the charts going to do? And if they start to turn bullish, it's hard to do to kind of ignore some of the chatter out there, the opinions out there. But that's the reality, and you have to kind of go with what the market is doing. I wouldn't have as big of a problem turning bullish right here if we would have had that at some point during this whole decline, had one of those panic sell-offs that I keep referring to. Now, panic sell-offs don't always mark the bottom, but they're a bottoming signal that every major market bottom has had. And so we never got that, and so that's still in the back of my mind that's going to be really tough for me to overcome personally. Now, for someone who's just starting out, it may not be tough at all because you don't have years of experience to draw on where you've seen it happen every time. It might be easier to grasp maybe this time it's different type of possibility. But again, from a probability standpoint, that's going to be a hard one for me to really start to turn bullish here without seeing that. And it could be both, as I talked about in a previous class. It could be that we break out above here, we get a run up. This is just a larger wave A of a much bigger correction pattern. Maybe we rally up into this area here, and that ends up being wave B, and then we get the big panic sell-off where it comes down, and you get wave C. That would probably be my next outlook that I would turn to. And you can still trade that. We could still trade this move up. We could still hedge and trade inverse ETFs on the way down. There could still be stocks that are going up when the market is going down. We witnessed that all last year. We still have some bullish trades. But the reason why we don't want that to happen is it would just prolong everything. It would just push everything out another. I mean, we're going to be in this corrective mess and bear market for another, 8 to 10 months or so, or maybe, or for most of the year. And nobody, I don't think anyone wants that at this point. We'd rather just get it over with, get the sell-off over with, and then we can start really having more confidence looking at patterns that might have bottomed and start moving back up. So this is a critical spot. Now, if we zoom in, we can see, you can see that reflected here over the last few days. On Thursday, again, the trend line comes like right through. I'm not going to draw this very well, but it's like right through here. I mean, we closed right at it on Friday. We got a little bit above it today, but we're kind of looking like we could close right at it today. If you look at the price ranges that I talk about, on Friday here's Thursday's range. Now we did break above Wednesday's range on Thursday. We did close above it, but we closed right at it on Friday. And then today, if you look at Friday's range, we're kind of inside of Friday's range. It's just stalling right here. But again, I'm there. What we're also seeing, which would be a little bit more bearish, is we're seeing a mixed market day today, meaning that the Dow and the S&P are down. Well, the Dow is down, S&P is basically flat, and the NASDAQ is up a little bit. When you start to see a mixed market like that, where some indexes are up, some are down, that tends to be a little bit more bearish. Although, again, it's not something that's a real, it's not something if you see that immediately that the market is going to drop immediately, but it tends to show a little bit of a fractured market. And so we'll see if it could just be that the market is trying to decide whether to break out of this area or not. By the way, this stuff I'm showing you, anyone that knows how to read a chart is seeing this, and believe me, these big institutional traders are aware of this key area right here. So it's not like we're the only ones seeing this as being a critical spot. And I think that's partly why it's stalling right here, is that the whole market is collectively showing signs of indecision. If you don't think that Friday's move was an indecision move, look where we opened. We opened all the way down here. It looked pretty ugly at first at the open, and then it managed to rally, but it couldn't even rally above or close above Thursday's high in any significant way. And then today we've got what we call a spinning top candlestick formation, which is the classic sign of indecision. So it's important to recognize that, because if you're saying, I know what the market's going to do, it's going to go up, or I know the market's going to go down, that's not what's being reflected in the chart or the price action. And so be careful about your confidence, because what the market is showing is it can go either way, and we want to recognize that. As part of my job here is to point that out and show you that that's what the market is telling us, is there's indecision right here. And why not wait for it to show us before we start to react? If it can break out right here, great. If it can't, okay, then it's showing us what it's doing. Now, if we move on to the Dow, you can see the Dow is having a down day, and it's what we call a bearish inside candle right here, where you have a bullish candle from Friday closing higher than where it opened, but now we're inside of it. We opened lower than the close of the high point, or basically the body of the candle. So the close of Friday, we opened below that, and we're still trading above the open of Friday. So it's trading inside of that candle, and the key to this is it's the opposite direction, and it's in the opposite direction of the trend, meaning that you have a run up like this, you get a bullish candle, and then you get the bearish candle inside of it. That's a bearish reversal candle. Now, You don't always get with all these candlestick formations. It's always important to point out you don't always get the move that it's signaling. If they worked 100% of the time, we'd never lose money, and that's all we would focus on is what does that candle look like, and we'd make a gazillion dollars. But it does show what it shows you is the high probability move in the short term. Meaning you see a bearish reversal candle, there's a high probability you're going to get a downward move the next day. If this holds into the close, there's a high probability we'll see a downward move in the Dow, because we're looking at the Dow tomorrow. Doesn't mean that it's going to lead to a longer move down, okay? These price action candles are very short term. But if you say, okay, the S&P is bumping up against that resistance. By the way, the Dow isn't bumping up against the downtrend line. So it's not in the same chart condition as the S&P. But if it's showing that it could drop down and the S&P is sitting at that critical resistance level, could you say that could this be the start of a if this holds, could this be a signal that there's a start of a bigger decline? This is just showing a short-term possibility or probability that the market drops the next day. Could you then look at the larger chart? In this case, it would be apples to apples, though, because you'd be basing it off of what the S&P. Could that mean that the S&P is maybe more likely to drop down and follow the Dow down if it goes down? Not a real strong correlation there yet, but this is showing that at least for the Dow, there's a pretty high probability that it goes lower. Now, let me show you just recently, though, where we had a very strong bearish reversal candle that didn't lead to a move down, just to show you it doesn't always work. I could show you a ton of times where it does work, and you see it all over the place, but there are a few times where it doesn't. And that's what keeps it so we don't know exactly what's going to happen. That's so it keeps it allows it to still be a marketplace. But we had this bearish reversal candle last week that was a pretty strong reversal candle. And it came in the context of what looked like a bearish ABC pattern right here that looked like it was correcting this move down. I tell you what, and I'll trade this every time because probably 8 times out of 10 it's going to work. But it shook it off. It did open a little bit lower that next day, but then it took off the next for the rest of the week there, and didn't reverse. So just keep that in mind before you're going to run out there and short off of just a bearish inside candle there. What would be confirmation though is if we did get a move lower and we closed below basically the range here of the last 3 days, if we could close below that and close at the lows of the day and pretty high volume, good volume on the selling there, then it would be there would be a pretty strong probability that you're starting maybe a bigger move down at that point. But that's something I would look for. Now, what if it shakes it off? Well, on the Dow here, you'd be looking at can it break out to a new high? You can see that the Dow has been outperforming. The Dow already broke that downtrend line there. Now you say, well, does that mean it's leading the charge higher? Again, this gets back to the argument I keep making, which is that it could be, but the Dow typically isn't the leadership. It's not the one usually leading. Usually the NASDAQ or the small caps are leading the way. And so, but if it breaks out above here, then the market's going to break its down. The S&P is going to break its downtrend line. You're not going to see that big of a divergence in the Dow and the S&P. So, that would be a reason to be a lot more bullish. If the Dow breaks out above here, S&P breaks its downtrend line. Again, you got to recognize what's actually going on at that point, and trade that direction. NASDAQ is up a little bit today. Not the NASDAQ chart. Hold on. Here's an NASDAQ chart. All right, so you can see it's up a little bit, but not by much. It's still a little bit of an indecision candle that we're seeing here. And this is what, again, has been bothering me for the longest time, is that the underperformance. Typically, the NASDAQ 100 is leading the way. I mean, look at, it's not that far away from that October low. It's not leading the way up, and it's still a little ways away from its downtrend line. So it could, technically this could rally up a little bit further. I don't think it would. It would take a pretty big divergent day where the Dow's down pretty big and the NASDAQ's 100's up really big, and the S&P is still basically flat for it to hold that, the S&P, for it to hold that trend line there. But again, if it's leading the way, you should see the NASDAQ 100 breaking out above that downtrend line before the S&P does. We're not seeing that. It's lagging. It just, that's what I'm saying. We're getting some mixed signals here. And there's even some mixed signals when we get to the chip stocks here in just a second, because that has a bullish divergence. If you look at the chip stocks as being leadership, Russell 2000 has been on a pretty strong run recently, and again, this you tend to look at the Russell 2000 as being a little bit of a leadership. It's bumping up right against this resistance area. Now it has a little bit of a bearish candle today. See if that holds into the close. But this is something I'm going to be watching over the next couple of days. Do we break out above here, or does it sell off from that critical area? So you can see that almost, although the charts are a little bit different, they're almost all in critical spots where it could break out or reverse. There's no clarity in the chart. It's still, a lot of these are showing it could go either way. And I know that's not what you want to hear, but that's kind of what it's showing us. All right, let's move on to bonds here. I'm not going to spend much time on this one because we've kind of identified this as the key range. The price action is not, we haven't been getting any sort of corrective moves, choppy sideways. Could you make an argument this is looking a little bit choppy through here? Yeah, maybe. Could it be that, maybe this is a wave A, wave B, and you get a wave C, and then, you take off or something like that? I just decided that, here's the range. If we break out above here, that'd be bullish. If we break down below here, that'd be more bearish for bonds. And it's just hard to read. Now, obviously, in the near term, the trend is up. But again, trying to read the bigger picture here, is this in a trend reversal where it's reversing back up? It would definitely look that way if it breaks out higher, because then you've got a higher low, higher high. You can use that basis for believing that it's now acting like an uptrend. But if it reverses back down, raise some of these lines, if it reverses back down and goes below here, now you've got a lower high, lower low. That's acting more like a downtrend again. So, boy, this is getting real fun here. The bond market's not giving us any clarity. Nothing's giving us any clarity. So, but the funny thing is, though, is that it's important you recognize this, though, because this happens a lot to me where I'll be analyzing stuff and I'm looking for clarity. You're always looking for clarity. You want to be confident in a direction, but the market's not giving you that. It's important you recognize that it's not giving it to you. So you don't want to be drawing any big conclusions, bullish or bearish, when that's not the signals you're getting from your analysis. You got to recognize what the analysis is telling you. And by the way, remember I told you before I started class, I couldn't find any stocks that I really wanted to bring up and show you in class. I did look at a ton, but I didn't find anything I liked. Things were either overly stretched to where I wouldn't want to buy in at that point, or they were sideways where it didn't look like there was any strong direction. And so it's not surprising I couldn't find anything I really liked when I'm going through this analysis with you and seeing that the market conditions aren't showing us any strong direction either. It happens a lot. And like I said, it's important to recognize that, because if you're itching to make a trade, if you're just dying to make a trade, then what you could do is you could find something. If you search long enough, you could find something to trade. I can always find something to trade. But the question is, should you? When everything else is screaming, sit tight and do nothing, then you better recognize that and not go continue to find something to trade, because you're probably going to be getting into something that's going to hurt you. And you definitely wouldn't want to be getting aggressive and getting into a whole bunch of trades. You know what the worst time, the worst position to be in, the most dangerous position to be in for a new trader is when you put money into a trading account and the money finally clears. You transfer money from your savings or your retirement or whatever into your TD Ameritrade account or whatever broker you're trading with, and remember, you have to wait for it to clear. Even if you're wiring money, there's a period that it takes to clear, and you can use your funds and trade with your funds. The most dangerous period is when those funds actually clear, especially if you're brand new and you don't know what you're doing, because you want to get all that money out there, and you want to hope that you're right. You don't even know what you're analyzing, but hope you're right, or hope the guy you listen to on TV knows what he's talking about, which he probably doesn't. That's the most dangerous time and that's where people end up usually wiping out their accounts very quickly, is they don't wait for the right conditions. And that's what we're trying to teach, is to wait, to be patient when you need to be patient. Now, gold, I told you, gold's in a position where we could pull back. Now, I'm in the gold trades for a much larger run. So I'm not going to, even though it looks like in the near term we could pull back a little bit in gold, I'm just going to stay in these trades. I moved my stops up last week a little bit, not by much, but you can see that there's two things here that are screaming for a potential pullback. Number one, we already recognize we're in the extreme reversal risk range. We're stretched. We're a little bit overbought. It's gone up a little bit too far, too fast. And then what do you see right here? You see a bearish inside candle. You had a big bullish candle on Friday. You got a bearish candle. The red means it's trading lower than where it opened. The gray means it's trading higher. This closed higher than where it opened. It closed up. Now again, we got an hour and a half before the market closes. Could that change and this look different at the very end of the day? Yeah, it could. But as of right now, this is showing a bearish inside candle. And it's showing you that there should be a downward move off of this tomorrow. And then you line that up with the extreme reversal risk, there's a very high probability you'll get a little bit of a pullback here. Now, the only thing I think could delay that, because these commodities are tied into the movement of the dollar quite a bit, is if suddenly the dollar had a big drop. That would tend to be bullish for commodities. They have an inverse relationship typically. They don't always move in opposite directions. But let's say there was some other event that caused the dollar to drop. It could allow oil and gold and other commodities to rally despite this bearish candle and despite the extreme reversal risk that it's in right now. So again, the point I'm trying to make is, just because there's a very high probability that gold should pull back right here, again, there are no absolutes in trading. There could be something that delays that a little bit. Although that's all it would probably be, is just delay it. In these conditions here, if you didn't get a bearish pullback right here, if for some reason it managed to go a little bit higher, it would only push your extreme reversal risk further to the right and just mean that pullback is probably within days. So sometimes, the way I look at this is kind of like if you're on a cliff, you're tired, you're barely hanging on. Could you still go a little bit higher on the cliff? Yeah, but you go a little bit higher, now even more tired. It's just the bottom line is that you're tired and you're probably going to fall back down a little bit, okay, or come back down a little bit. So whether it happens right here or it tries to hold on a little bit longer, you're very close when you see these conditions. You run up already and you start seeing these bearish reversals. There's a very high chance that within a few days or so, you're going to see some sort of a pullback out of that. So we'll keep an eye on that. Now, could I go ahead and just take profits on my gold trades here, or wait to see if it pulls back for a few days and then jump back in again? Yeah, you could do that. And maybe we'll do that on one of them. Maybe we'll just go ahead and get out of one of them with the intention to get back in if it pulls back a little bit. That way we're not just giving back. It just depends on, it really depends on, are you a trader or just an investor? Are you just trying to put stuff in and then not watch it, or not, I shouldn't say not watch it. You're always going to be needing to watch it, but are you, you're not worried about the corrections. You just want to hold through the corrections as long as it's in that uptrend. Just continue to ride the uptrend. If you're a trader, and this is why I have a tough time just staying in trades through corrections, is because I know how to read this price action. I know there's a high probability it's going to pull back a little bit, and it's just hard for me even to lose $1 knowing that there's a high probability I'm going to lose that dollar or whatever. There's a tendency for me to just go ahead and get out, take the profits there, because I know I can always get back in. But sometimes it takes off again really fast. It pulls back and then takes off. It has a really big up day, and then you're chasing to get back in again. And so there's pros and cons to every trade management decision you make. Maybe just for the fun of it, since we're not doing anything else, we'll go ahead and we'll take a look at which one of the two gold trades we have and see if we want to take some profits on those and see if it pulls back a little bit. All right, oil's in a really tough spot. Now, I've told you that this is kind of the key area right here. Here's where we had the lower low down here. This was the last lower high right here. If we can break out above there, now you've got a higher high after the lower low. That would also be a higher low right there, but that's not an important higher low until you can break out to a higher high. So it has been moving up recently, but you have a very strong bearish reversal candle today. Although we had a very strong bearish reversal candle on Thursday, it didn't reverse. So, but it's interesting that you're getting two of those in a row. Like I said, sometimes you can shake off that move and you're trying to hang on. Is this trying to hang on, trying to go higher, and could it fail or falter? We'll see. Oil, though, has been tough to read. It's just been in the sideways range. And, there's other reasons to like that resistance area right up in here. You've got support back here, support back here, support back here. A little bit of resistance in that area. It went a little bit above it there. A little bit of support here where it bounced, resistance here where it declined. They can break out above here. That would definitely be a little bit more bullish for oil. But my argument could be, is bullish for oil, bearish for the market. There's an interesting argument there. Would it increase inflationary pressures? So then you could go back and say, okay, then is the fact we're getting a bearish reversal candle today, is that actually more bullish for the market? And does that mean oil's going to pull back, which would help the kind of the bullish argument? Yeah, sometimes you can go back and forth on this stuff all day long. The dollar been trending down, has a little bit of a bullish candle today, though, possibly a bullish reversal candle. Was at one point showing a bullish engulfing, where it opened lower than Friday and was trading above Friday's open right there. And it was, that's called a bullish engulfing. Now it's backed off a little bit, back into the range of Friday. We'll see how that closes there. The trend has been down, and there's not a real strong indication of a bullish reversal. Although it is getting stretched, you could make the argument it's a little bit oversold. It's in the extreme reversal risk down here, kind of right at the midpoint. If it does go a little bit lower, it's getting close to where it could bounce. Now, by the way, it doesn't mean that when you get in these extreme conditions that it doesn't mean that the dollar's about to go into an uptrend. When it gets extremely oversold like that, it could mean that it's going to rally up in a correction before going, it could be due for another correction. And I say this a million times, but again, I always have new people. It doesn't have to go in the opposite direction to alleviate the overbought or oversold condition. It could move sideways. We could just see a sideways move, kind of like we saw right through here, or even right through here, and that can alleviate that overbought or oversold condition. But with the way where it's at right now, the probability is it's either going to rally a little bit or move sideways. It's not as likely to go too much lower. It could go a little bit lower, but then you're really getting oversold. So it's important to recognize that condition because yes, the trend is down, but do I want to short the dollar right here? If you're shorting, no, it's a dangerous spot to short because of that reversal risk. Not a good entry point. And it's still too early to see that it's rallying to be bullish on the dollar. So I wouldn't be, looking to buy the dollar yet. It's in that area of limbo again, where you need a little bit more confirmation. And then the VIX, and this is probably my biggest bullish argument. And I'm going to switch over to the other VIX chart. This is why I just cannot see how the market can rally enough to break out of that range significantly, is because not only did we get to 20, we've now traded below 20. On Friday, we actually got down to 18, the low 18s. And that's the most extreme that we've seen during this whole the market decline. So we're bumping every time we bumped up against that resistance, that downtrend line. Every time we bumped up against that downtrend line, the VIX has gotten to at or below 20, and then we've had a big sell-off right afterwards. Got to a little bit below 20, had a big sell-off. Got to a little bit below 20, had a decent sell-off, not a huge one back in the beginning of December. Now we've had our most extreme reading right here, down to 18. How can the market rally significantly right here? Could it break out of that? It could break out of that downtrend line, but how much further could it go with the VIX down at 18? Because if it breaks out of that downtrend line, the VIX is going to likely go down again. You get down below 18. That'd be a very dangerous spot to be buying in at that point. So if you've been just itching to go long and really buy in as soon as that market, if the S&P breaks out above that downtrend line, this is screaming that you might want to rethink that and be very cautious. And if you did get into something, maybe one stock, don't get into a whole bunch. Don't load up right there, because this is screaming that we're due for another pullback. But it's just a lot of mixed signals right there. This alone, though, what's keeping me bearish, is I just can't see a significant rally with a VIX down that low. Now, can you get lower on the VIX? Yeah, you can, but you typically get it lower on the VIX during bull markets and really healthy economies. And even then, some of these readings this was during the end of the bull market last year, even then we got to about 16 before we'd sell off. So I don't know. This is where you get into the argument of is it possible though that we just see the market takes off and the VIX comes down to 16? Yeah, it's always possible, but from a probability standpoint, and it's hard to wrap my head around that from a probability standpoint. But I've been doing this a long time, and there are times where the market does stuff that just does not make sense. And could this be one of those times? Just never know. But all right, so that's something to really keep an eye on. By the way, while I'm here, I can show you that downtrend line in a lot more detail. You can see. Now we have been above it. Back here, we opened above it again, traded above it, and then closed right below it. Here was that CPI report that came out in December, opened above it, but closed down here well below it. Now we are above the 200-day moving average. We closed above the 200-day moving average on Friday, but we also closed right at that trend line, right at it. About as dead on to that trend line as you could get. But we closed above the 200-day moving average here and here, and still ended up selling off. So that's what I'm saying. That alone isn't necessarily mean that the market's going higher. I heard a lot of people talk about, we closed above the 200-day moving average, so that means great chance the market's going to go higher or something like that. Like, well, not unless it can break out above that trend line there. And then today we've been all over. We've been all the way up here, we've been down here. We're right at it. And remember, that's a downtrending line, which means that you'd have to start to see lower closing prices, right? Otherwise, if you have a day where you close higher than the day before at this point, then you're probably going to break that trend line. And this could be where it could be the biggest. This could be where it's the biggest suckers breakout too. I could see a situation where we do have a clear break of that trend line, sucks a ton of people in for a couple of days, thinking that was it. We're not, people don't know how to read the VIX indicator, and then that's what could really trigger the big sell-off. Is if people start to panic now as it starts to drop. They thought for sure it was going to go higher right there. I could create some panic selling if that scenario plays out, but we'll see. Now, before I show you only bearish reasons for the market, look at the chip stocks. Remember, chips tend to be leading. Now, we're comparing the chip stocks with the NASDAQ 100. They tend to be the leading group in that NASDAQ 100. They tend to lead the way. So look at the October low right here, and then look at, we're about to break out of this possibly break out of this little consolidation area right here. Look how much further we are up from those October lows, and then compare that to the NASDAQ 100. It's not. It's still ways away from that breakout area. It's still pretty close to those October lows. So the chip stocks are leading the way. They're showing leadership to the upside right here. You can't call something a leadership and then ignore it when it's showing leadership. So if you're going to make a bullish argument, that's something we got to keep an eye on. Is do we start to see that if the market breaks out and starts to rally, what it tells me is that I'd want to be going and looking at some of the beaten down NASDAQ stocks, because as long as the chip stocks hold up and continue to move higher, then those other stocks should follow. Now, I'm not saying that'll be what happens, but I do need to point that out, that the chip stocks are showing some leadership compared to the NASDAQ 100. We'll see if that continues. But recently, it's the chip stocks are confirming this recent rally as being a pretty legit rally from that standpoint. So, all right. Bitcoin's been surging too, although it's got a little bit of a bearish indecision candle today. We'll see how that plays out. It's been very beaten down, so a lot of this is what we'd call a short covering rally. Now, almost every bottom starts with a short covering rally because the shorts, first what happens is the shorts cover their position. That means they buy to close, so there is a buying action to close out a short position. And then usually you look for the new buyers to come in to push it up higher from that point. And that, so whenever you get a bounce, usually a bounce in a downtrend is first short covering that takes place, the shorts taking their profits. If that's all there is buying based off short covering, then it's not going to last and it's going to continue to drop, which is why you stair step down. The shorts cover, it reverses back down, they jump back in, they push it lower. When you get a trend reversal, what happens is you get that short covering rally, and then buyers, you see the buyers step in. Usually you'll get a consolidation, and then the buyers step in, and now you're stair stepping up. Now you're getting real buyers that are coming in. So you don't want to react to that first move off of the lows, because it could just be the shorts just covering, and it could just roll over and go back down again. You want to see. So what I would like to see, it doesn't look like the. Yeah, so like that doesn't look like the Bitcoin chart. So what I'd like to see is, what's going to tell me a better direction for Bitcoin is how does the next, how is there a correction right here? Do you see it start to move sideways or choppy? Because you've got an impulsive move up, which should follow, if this is an uptrend, is it should have a pullback that doesn't come right back down, that is steady. There's not a lot of heavy selling in it. Look for that bullish ABC pattern. That would be a sign that it's looking a lot more bullish. If it comes right back down in an impulsive move down, then that tells you that was just short covering. There's no buyers yet, and it's you want to stay away from it. So that'll be something to keep an eye on over the next few weeks there. See how that kind of plays out. All right, let's take a look at the S&P chart before we wrap things up. Like I said, I know I did say I was going to consider an adjustment in the portfolio here. I mean, they're both gold stocks. Let's take a look at NEM's already sold off a little bit. GDX, same. They look the same. GDX is in the buy range. Let's see what NEM. They're both in the buy range. I'll go ahead and jump out of GDX. We'll jump back in. NEM, I'll leave that. That was the first one I got into on NEM, so I'm up a bit more on NEM. And we don't have to do anything, but just for the sake of that bearish looking candle on the GLD, we might be jumping back in on Thursday's class, but that'll give us something to do on Thursdays. So let me go ahead and just exit GDX here, see if we pull back a little bit further off of this. Everything's running slow right now. Why is that? There we go. All right, so let's go ahead and sell GDX for 31.56. Yeah, so it's showing 32.65, but the current price is right here, 31.56. So it's a little $600 profit, not too bad. We'll take that. And then, like I said, if it pulls back a little bit, we'll jump back in. Let's just take a peek at the SPY and then we'll call it a day. Unless it takes too long to pull it up. I wonder if I just typed it in here, if it'd be a little bit quicker to pull up. There we go. Let's try that. Yep. Yep. Still showing indecision. But let's see if it holds that trend line into the close. It just keeps hugging it, and it's like, it's kind of frustrating. It's like, I get impatient sometimes when it sits too long at some of these areas, these key areas. All right, that's all I have. We'll see you on Thursday for the stock specific class. Have a great week, everyone. Bye now.